Today, we will talk about assumable mortgages. An assumable mortgage is an arrangement in which an outstanding mortgage and its terms can be transferred from the current owner to a buyer. An assumable mortgage is a type of financing arrangement where an outstanding mortgage and its terms are transferred from the current owner to a buyer. This allows the buyer to avoid obtaining their own mortgage and take over the existing one. When a homeowner decides to sell their home, they may be able to transfer their mortgage to the home buyer. This means that the buyer can take over the current principal balance, interest rate, repayment period, and other terms of the seller's mortgage, without going through the process of obtaining a new loan. Popular types of assumable mortgages include FHA, VA, and USDA loans. Each type has specific requirements and approval processes for the buyer to assume the mortgage from the seller. Assumable mortgages are advantageous in high-interest rate environments, as the buyer can take on a loan with a lower interest rate. However, they may also require the buyer to make a substantial down payment or secure a second mortgage, especially if the seller has a large amount of home equity. The final decision over whether an assumable mortgage can be transferred lies with the lender of the original mortgage, not the buyer and seller. The buyer must meet the lender's requirements and be approved for the mortgage assumption. Assumable means that the buyer can take over the existing mortgage of the seller, relieving the seller of the debt. Not assumable means that the buyer cannot take over the mortgage from the seller, which is common with conventional loans. To assume a loan, the buyer must qualify with the lender. If the price of the house exceeds the remaining mortgage, the buyer must remit a down payment that is the difference between the sale price and the mortgage. USDA, VA, and FHA loans are assumable, with specific requirements that both the buyer and seller must fulfill for the loan to be assumed by the buyer. Assuming a loan may be favorable when current interest rates are higher than the existing mortgage's rates, as closing costs are lower. However, if the seller has a considerable amount of equity in the home, the buyer will need to pay a large down payment or secure a second mortgage. An assumable mortgage may be attractive to buyers when current mortgage rates are high and because closing costs are lower. However, if the owner has a lot of equity in the home, the buyer may need to pay a substantial down payment or secure a new loan for the difference in the sale price and the existing mortgage. Here are 4 key takeaways. 1. An assumable mortgage is an arrangement in which an outstanding mortgage and its terms can be transferred from the current owner to a buyer. 2. When interest rates rise, an assumable mortgage is attractive to a buyer who takes on an existing loan with a lower rate. 3. USDA, FHA, and VA loans are assumable when certain criteria are met. 4. Buyers must still qualify for the mortgage to assume it. Hope this would help. Thanks for watching.